We are not poor. We are only undercapitalized. I want you to really let that sink in for a second. We are not poor. We are only undercapitalized. That is a direct quote from Dr. Akinwumi Adesina, who is one of Africa's most eminent economists.
Yeah, it's a completely paradigm-shifting way of looking at international finance.
It really is, and it is exactly why we are here today. Welcome to this deep dive. If you're joining us, you likely track macroeconomics, you follow shifting geopolitics, and you want to get straight to the mechanics of how capital actually moves without drowning in information overload.
Right.
So today we are pulling apart a really fascinating briefing document. It's titled TAF.February.PEDF.
Yes.
And it outlines what the authors describe as Africa's investment reckoning. Our mission today is to explore a massive, a systemic and psychological pivot that's happening right now in emerging markets.
It's huge.
We're examining a relatively new initiative called the Global Africa Investment Summit, or GAIS, and their highly specific blueprint for basically transitioning the African continent from being a reactive borrower of concessional debt into a proactive originator of investable assets.
And that transition,
Yeah.
that transition is absolutely critical to understand, regardless of where your primary market interests lie.
Exactly.
Whether you are analyzing long-term yield curves or, tracking the supply chains for green energy tech, or even just watching how international trade corridors are being redrawn, this shift is foundational.
Because it touches everything.
Right. We are essentially looking at an attempt to completely rewrite the financial architecture of an entire continent. If the underlying mechanics of how a region funds its industrialization actually change, the ripple effects are going to touch everything from currency valuations to, honestly, the long-term stability of worldwide markets.
Okay, let's unpack this.
Yeah.
Because to really grasp the strategy outlined in the GAI's briefing, we have to look at the limitations of the old model first. For decades, African economies have operated within this incredibly rigid financing architecture. According to the document, this relied on a cocktail of aid inflows, concessional lending from institutions like the IMF and the World Bank.
The usual suspects.
Right, the usual suspects. Plus the export of raw, unrefined commodities and these highly volatile, just completely unpredictable surges of foreign direct investment.
Yeah, and it was a system inherently built on external dependency. Now, to be fair, the source document is objective about the historical context. It notes that this framework did deliver certain baseline necessities. It built early infrastructure, stabilized fiscal accounts during severe crises. But the fundamental flaw, the real crux of the historical analysis here, is that while it provided temporary liquidity, it entrenched systemic vulnerability.
It's a Band-Aid.
Exactly.
Yeah.
The architecture left these economies entirely exposed to macroeconomic headwinds.
And the briefing emphasizes that point heavily. When a global shock hits, whether it is a pandemic or a sudden geopolitical conflict or even just a spike in U.S. interest rates, the immediate reflex is capital flight.
Instantly.
International money just retreats to safe havens, and the cascading effect of that, you get intense currency depreciation, which severely tightens credit conditions domestically.
Right.
So you end up with this tragic irony where borrowing costs for these developing nations absolutely skyrocket at the exact moment their public spending needs are most acute.
Precisely. To put it in terms familiar to anyone who watches a venture capital, the old model is a lot like an undervalued, asset-rich startup that has just become trapped in a cycle of predatory bridge loans.
Oh, that's a great way to think about it.
Yeah, like the underlying unit economics might actually be solid, right? And the intellectual property, or in this case, the natural resources, and the demographic potential is incredibly valuable.
Right. It's like living on a high-interest credit card while you own a gold mine that you just can't afford to excavate.
Yes. Perfect analogy. The company is constantly taking on expensive short-term debt just to make payroll. What GAIS is proposing, according to the briefing, is the equivalent of preparing that startup for a proper IPO.
They want to attract institutional capital based on actual unit economics.
Exactly, rather than just begging for another bridge loan to keep the lights on.
And that is exactly the pivot the architects of GAIs are trying to execute. The initiative, which is spearheaded by figures like Dr. Edesina, who is the former head of the African Development Bank, and renowned economist Marjorie Krauss, it fundamentally reframes the approach.
It really does.
The core argument in tf.february.pdf is that Africa possesses abundant sovereign assets that are currently mispriced and vastly underleveraged in international capital markets. They aren't talking about potential anymore. They are talking about tangible assets waiting for standardized structuring.
What's fascinating here is how that shift in focus really anchors the entire document. Historically, these assets have either been poorly structured or they just haven't been prepared for the rigorous underwriting standards that institutional investors require.
Right, because if a pension fund in Europe or a sovereign wealth fund in the Middle East is going to deploy capital,
They demand strict governance frameworks, period. And because those frameworks have often been missing or opaque in various African markets, it creates a persistent risk premium.
and that risk premium is the killer. I mean, it wildly inflates the cost of capital. It makes borrowing to build a renewable energy grid or a cross-border railway so expensive that the project's internal rate of return just becomes completely unviable.
Yeah, the math just stops working.
So what is the actual mechanism GAIS is using to fix this? The document states their core strategy is prioritizing preparation over presentation.
Right, so instead of hosting a broad symbolic summit where politicians basically just stand up and ask for infrastructure funds, GIS is focused on building standardized valuation templates.
The nuts and bolts.
Exactly. For example, instead of a vague pitch for, green energy, they are working to specifically price the future yield of a geothermal plant in Kenya.
Okay.
They are creating a transparent, standardized data room so that a foreign institutional investor knows exactly what their 30-year return on investment looks like, with clear regulatory guardrails built directly into the term sheet.
So they're completely replacing the political pitch with a highly technical, bankable pipeline.
Yeah.
Here's where it gets really interesting. The timing of this, as the briefing points out, is not a coincidence at all. We are looking at a unique convergence of macroeconomic factors right now.
We are.
In advanced economies, you have slower growth trajectories. Meanwhile, institutional investors are sitting on literal trillions in capital, and they are just starved for long-term yield.
That capital needs a place to deploy where it can actually grow over a multi-decade horizon.
Yeah.
But if we connect this to the bigger picture, on the flip side, you have African economies that are starved for productive transformation.
Right.
And the source document highlights a ticking clock here, which is the demographic boom. Africa's working-age population is expanding faster than anywhere else on Earth.
It's massive.
Without immediate, highly structured investment in manufacturing, transport, and digital infrastructure, that demographic expansion risks completely overwhelming regional labor markets and social systems.
But if you flip the script, right, if that investment actually arrives through these new standardized frameworks, that exact same expanding population becomes an unprecedented engine for massive industrialization and domestic consumption.
Exactly. It's a dual edge.
So if you're listening to this and looking at it from an investor's perspective, you're probably wondering what the actual growth engines are. And the briefing breaks this down into 4 main pillars.
Let's go through them.
Yeah, starting with the demand for long-duration assets.
Right. So Pillar 1 is the alignment of infrastructure needs with patient capital. Things like solar grids and massive logistics corridors in emerging markets perfectly match the liability matching requirements of a pension fund.
Because they need that stability.
Right. These funds need steady, predictable returns for 30 years to pay out their retirees. A well-structured toll road or a sovereign-backed renewable energy purchase agreement provides exactly that kind of long-duration yield.
That makes a lot of sense. Moving to Pillar 2, the briefing details the mechanics of blended finance and co-investing.
This is a big one.
Yeah, this is where we really get into the actual plumbing of the deal structures. It highlights the expansion of African domestic capital pools, specifically local pension funds and domestic sovereign wealth funds. So GAIS is acting as a bridge to connect these growing local savings with international co-investors.
And I want to emphasize that this is a critical point that often gets overlooked in macro discussions about emerging markets.
Yeah.
By deepening local financial participation, you fundamentally change the risk profile.
How so?
Well, when an international fund co-invests alongside a local Nigerian or South African pension fund, it inherently lowers the political risk.
Oh, I see.
The host government is far less likely to expropriate an asset or arbitrarily change regulatory frameworks if their own citizens' retirement savings are tied up in the exact same project.
Because the political fallout would be disastrous domestically.
Exactly. It creates a shared domestic stake in the success of the investment.
It aligns the incentives beautifully.
Right.
Okay. Pillar 3 focuses on the tech ecosystems, which the briefing argues is essentially the digital layer enabling all this traditional infrastructure.
Yeah.
And we aren't just talking about consumer apps here. We are talking about mobile money platforms and fintech solutions that are actively bridging the gap for the unbanked.
The transaction volumes on these platforms are staggering. And from an institutional investment perspective, this tech layer is vital because it creates verifiable data trails.
Right, because before this,
In the past, the informal economy was a total black box. You couldn't underwrite a loan to a smallholder farmer because there was just no data.
no credit history, no paperwork.
Right. But now, through agritech and mobile payment histories, there's a digital footprint. Institutional investors can actually model risk and securitize assets based on that data. It allows capital to penetrate much, much deeper into the productive economy.
And that ties directly into Pillar 4, which honestly might be the most geopolitically significant of all of them, the worldwide energy transition.
Oh, absolutely.
The global push for decarbonization relies entirely on critical minerals. We are talking about cobalt, copper, lithium, manganese, the foundational materials for electric vehicle batteries and green technology supply chains.
The briefing is very clear on this part. The historical model was simply to extract raw ore and export it for processing somewhere else.
Right.
That is a low-margin game that keeps the host country perpetually at the bottom of the value chain. The GAI's model pushes for investment in domestic processing and refining capabilities. That is where the real value is captured.
But building a lithium processing facility requires massive upfront capital.
Massive capital and deep technical expertise, which brings us right back to why they are shifting away from sovereign debt and toward equity.
Okay, I actually want to push back on this equity model for a second.
Sure.
Because I get the theoretical appeal, but realistically, how do you convince a risk-averse foreign investor to take an equity stake in a region historically plagued by currency volatility?
It's a tough sell initially.
Right. If I am managing a billion-dollar infrastructure fund, debt feels safer because I am legally guaranteed repayment, whereas equity means I absorb the operational risk. How does the briefing actually address that hesitation?
It's a very fair challenge.
Yeah.
And the document addresses it by outlining how equity actually provides better structural protection in these specific markets.
Okay.
See, when a developing nation takes on heavy sovereign debt, they are locked into unforgiving dollar-denominated repayment schedules.
Right.
If their local currency depreciates, the real cost of that debt explodes. That forces the government into austerity measures or outright default. And that hurts the investor anyway. We've seen this in recent sovereign debt restructurings where bondholders have to take massive haircuts.
So debt isn't actually as safe as it appears on paper.
Exactly. It's an illusion of safety. Equity financing, particularly blended equity where risk is shared with development finance institutions acting as a first loss guarantor, it completely changes the calculus.
Because they're sharing the burden.
Right. The investor's return is tied to the actual productivity of the asset in the local economy. If they're invested in a transport corridor linked to the AfCFTA.
Which is the African Continental Free Trade Area.
Yes. And, by the way, AfCFTA is currently standardizing cross-border tariffs and creating the largest free trade area in the world by participant count.
It's a huge deal.
It is. So if an investor holds equity there, their upside is tied to the actual volume of trade.
They are essentially buying into the macroeconomic growth of the continent rather than just extracting a fixed interest rate from a government treasury.
Exactly.
They are in the exact same boat as the host country. If the project operates efficiently and trade volumes increase, everyone wins.
Yep.
And if it struggles, the investor shares the downside, which naturally forces them to bring not just capital, but actual operational expertise and technology transfer to ensure the project succeeds.
And that operational involvement leads right into the most crucial caveat of the entire briefing. This raises an important question, the accountability question.
Right.
Ambition without strict governance is dangerous. The document does not shy away from the risk of repeating extractive patterns of the past. If GIS is going to achieve durable success, it cannot just be a series of opaque financial transactions negotiated in closed boardrooms.
The guardrails have to be ironclad. The briefing specifies the need for highly transparent asset valuation, rigorous adherence to environmental safeguards, especially in that critical mineral sector we talked about, and equitable revenue sharing agreements.
Without question.
Because the ultimate test of this pivot from debt to equity isn't just a rising GDP figure or successful yield generation for foreign funds. It is whether the everyday citizen sees tangible benefits, real industrial growth, localized supply chains, and actual job creation.
The political legitimacy of this entire framework depends entirely on that execution. The projects have to successfully move from a theoretical data room to actual on-the-ground performance.
You have to deliver.
Investor confidence and domestic public support are entirely intertwined here. If the governance structures fail and the wealth generated by these assets does not broad-base the economy, the political backlash will shut down the exact regulatory stability that investors require in the first place.
It's a delicate balance.
Transparency is not just an ethical add-on. It is a fundamental requirement for the financial viability of the GAS handle.
So, what does this all mean? When we synthesize all of this, the departure from concessional lending, the creation of standardized valuation templates, the utilization of domestic pension funds, and the strategic pivot toward equity in critical minerals and tech sectors, what is the broader takeaway for you?
Well, the source material frames this as more than just a restructuring of capital flows. It argues that GAIS represents a profound psychological reset in international finance.
A psychological reset.
Yeah, it really is a reset of the narrative. For decades, the dominant economic analysis surrounding Africa has focused almost exclusively on deficits.
Right.
It was a story told through the lens of infrastructure gaps, financing shortfalls, and the constant need for external intervention. The GAIS blueprint entirely reframes the continent through the lens of its immensely valuable, under-leveraged assets. It changes the posture from asking for assistance to negotiating the monetization of strategic resources.
And markets are highly reactive to narrative coherence. Institutional investors aren't just parsing raw spreadsheets, They are looking for signals of long-term strategic direction.
Absolutely.
When multiple emerging economies align behind a standardized, meticulously designed investment platform, it drastically reduces the perception of market fragmentation. It signals a level of regulatory maturity that naturally compresses that risk premium we talked about earlier.
Which initiates a really powerful virtuous cycle.
Right.
Disciplined coordination and preparation leads to lower perceived risk. That lower risk translates directly into a lower cost of capital.
Yes.
Cheaper capital allows more infrastructure and industrial projects to actually reach viability, which drives actual economic expansion. And then that expansion reinforces the initial investor confidence.
It feeds itself.
It's a complete departure from the volatile boom and bust commodity cycles of the past. It is a calculated path toward building real resilience within the international market, rather than constantly reacting to its shocks.
By diversifying their capital stack, deepening local market participation, and aggressively prioritizing operational equity over sovereign debt, these economies are actively expanding their policy autonomy. They are attempting to anchor their industrialization in deliberate design rather than reactive dependency. It really is a real-time case study in how an entire continent is attempting to reshape the terms of global engagement.
It is. And as we wrap up our analysis of this briefing, I want to leave you with a final, broader thought to consider.
Okay.
We have spent this time dissecting how GAI aims to shift the paradigm from deficit and debt to equity and asset monetization. If they successfully institutionalize these frameworks, and if African domestic capital pools and digital ecosystems continue their current growth trajectory, the balance of power shifts.
Oh, massively.
How long will it take before those very same local pension funds and tech platforms transition from being co-investors in their own economies to becoming the primary leverage holders in the broader international market? We may not just be analyzing a region optimizing its own growth. We might literally be watching the foundation being laid for a future where these economies dictate the terms of international trade and capital allocation, rather than simply absorbing them.
It is an incredibly complex and consequential shift to witness, and it fundamentally changes how we should analyze emerging market data moving forward. Thank you for joining us on this deep dive into the TAFE.February.PDF briefing and the mechanics of this investment reckoning.
Thanks for having me.
We hope this breakdown has given you a clearer, more nuanced understanding of the structural changes occurring beneath the surface of the daily headlines. Keep questioning the consensus narratives, pay attention to the underlying financial architectures, and we encourage you to keep exploring the shifting dynamics of our world. We will catch you on the next deep dive.